I'm going to call the meeting to order. Jeremy, do we have a confirmation of a quorum?
We do have a quorum and the press has been notified.
Okay, good. All right, so we'll consider approval of the minutes that were held in May, on May 26th. Has everyone had a chance to look at those? And does anyone have any changes or substitute for any of those minutes? If not, I'll entertain a motion that we approve them.
I'll make a motion, Beverly.
This is George, and I'll second it.
All right, thank you, George. So we have a motion and a second. All in favor signify by saying aye.
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 Opposed, like sign. Motion carries. Okay, so next is the inducement resolution for the flats at Bardstown. Sam Thorner, you're up.
Thank you, Mr. Chairman, members of the board. The first item that we have for you today is the inducement resolution for the flats at Bardstown Apartments. The flats at Bardstown Apartments is requesting bonding authority in an amount not to exceed $21.5 million. The project was originally induced for $20.2 million at the April 28, 2022 board meeting. The project has requested an additional $1.3 million in bonds due to increases in construction and borrowing costs. The project involves the acquisition and new construction of 192 units located at various addresses on Buccal Bank Road and Bardstown Road in Jefferson County, Kentucky. The project will use income averaging to serve households at 30%, 50%, 60%, and 80% AMI. The 192 units will consist of 48 one-bedroom units, 62 bedroom units, and 84 three-bedroom units. As the financing for the project progresses, the Board of Directors of the Kentucky Housing Corporation must also authorize the issuance and sale of tax-exempt bonds through the approval of a final resolution. KHC has reviewed the preliminary submission of the applicant and recommends approval by the Board of Directors of the Kentucky Housing Corporation of an inducement resolution authorizing the tax-exempt financing for the flats at the Bardstown Apartments project.
Okay, thank you, Sam. Any members have any questions of Sam? If not, I'd entertain a motion to approve this inducement of resolution.
So moved, Gail.
Thank you,
I'll
Gail.
second, Susan.
Okay, we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. All right, Sam, you got several on here. So Sheehan Landing.
Thank you, Mr. Chairman. So this is for an inducement resolution for Sheehan Landing. The Sheehan Landing project is requesting bonding authority in an amount not to exceed $15 million. The project involves the new construction of 81 bedroom units located in the vicinity of Preston Highway, Louisville, Kentucky. The project will serve 80 households at or below 30% AMI. As the financing for the project progresses, the Board of Directors must also authorize the issuance and sale of the tax-exempt bonds through a final resolution. KHC staff has reviewed the preliminary submission of the applicant and recommends approval by the Board of Directors of an inducement resolution authorizing the tax-exempt financing for Sheehan Landing project.
Any members have any questions to Sam on this resolution?
It's Kathy, and I love seeing the 30% of AMI in a couple of these things. That's fabulous.
Yes, this will be a permanent supportive housing project in conjunction with St. John's Center.
If there are no other questions, I'd entertain a resolution or a motion to approve this resolution.
I move.
Okay, thank you, Kathy.
Gail.
Okay, we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Inducement resolution for Beecher Phase 4 apartments, Sam.
Thank you, Mr. Chairman. So Beecher Phase 4 project is requesting bonding authority in an amount not to exceed $38 million. The project involves the new construction of 210 units consisting of 89 one-bedroom units, 98 two-bedroom units, and 23 three-bedroom units located at 980 West Liberty Street in Louisville. The project will serve households at or below 60% of AMI. As the financing for the project progresses, the Board of Directors must also authorize the issuance and sale of the bonds through the approval of a final resolution. KHC staff has reviewed the preliminary submission of the applicant and recommends approval by the Board of Directors of Kentucky Housing Corporation of an inducement resolution for the tax-exempt financing for the Beecher Phase 4 project.
Okay, any members have any questions of Sam on this project? If not, I'll entertain a motion that we approve.
Beverly, I make a motion.
Okay, so we got a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. All right, the Prestonian, Sam.
Thank you, Mr. Chairman. So the Prestonian project originally received an inducement resolution on February 25th, 2021 in the amount of $50 million. Final construction costs are higher than expected, resulting in the project needing additional tax-exempt bonding authority in order to meet the 50% test. The amount of this inducement resolution would be for $55 million. The project consists of 343 new construction units. There will be 157 one-bedroom units, 146 two-bedroom units, and 40 bedroom units. This project will be located at 709 East Gray Street in Louisville, Kentucky, and will serve families at or below 60% of AMI. As the financing for the project progresses, the Board of Directors must also authorize the issuance and sale of the bonds through the approval of a separate final resolution. KHC staff has reviewed the preliminary submission of the applicant and recommends approval by this Board of Directors of a new inducement resolution authorizing tax-exempt financing for the Prestonian.
Any members have any questions of Sam on this project?
This is Kathy again. I also, Sam, throughout all of it, like seeing so many 3 bedrooms in good proportion being proposed.
Okay, thank you, Kathy. Any other members have any comments or questions? If not, I'll entertain a motion that we approve this inducement resolution.
It's PG. I make a motion to approve.
Thank you, Mr. Peoples. Have a second?
Steve will second.
Okay, thank you. All right, so we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. All right, Sam, you're on a roll. Crossing to South Park.
Thank you, Mr. Chairman. So this is for a final resolution for the Crossings at South Park project. This project was granted an inducement resolution on August 26, 2021 for bonding authority in the amount of $22 million. The final resolution is for the same amount. The project involves the acquisition and new construction of 192 units located at 10511 West Manslick Road in Louisville. The project will use income averaging to serve households at 30%, 50%, 60%, and 80% AMIs. The 192 units will consist of 36 one-bedroom units, 62 bedroom units, and 96 three-bedroom units. The development team is available in your packet, and KHC staff recommends approval by the Board of Directors of this final resolution for the issuance of bonds for Crossings at South Park.
Any members have any questions of Sam? If not, I'll entertain a motion to approve.
So moved, Gail. Second,
Okay,
Susan.
Okay, we got a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. All right, Sam, Churchill Park.
Thank you, Mr. Chairman. So this is for a final resolution for Churchill Park Apartments. This project was induced at the May 26, 2022 KHC board meeting. The project is requesting bonding authority in an amount not to exceed $31 million and involves the acquisition and rehabilitation of 248 units. The total project will be 248 units, but 236 of those units will be rehabilitation and 12 units will be new construction in the vicinity of 2161 East 19th Street in Owensboro. The project will serve 248 households at or below 60% AMI and will consist of 49 one-bedroom units, 112 two-bedroom units, and 73 bedroom units, and 17 four-bedroom units. KHC staff recommends approval by the Board of Directors of Kentucky Housing Corporation of this final resolution for the issuance of bonds for Churchill Park Apartments.
Okay, any members have any questions of Sam on this project? If not, I'll entertain a motion that we approve.
A motion.
Okay, we got a motion. Do I have a second?
Second, Chad.
Okay, we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. All right, so we're down to Yorktown. Sam?
Thank you, Mr. Chairman. So this is the final resolution for Yorktown Senior Apartments. This project was granted an inducement resolution on December 9th, 2021 for bonding authority in an amount not to exceed $8.5 million, and the final resolution would be for the same amount. This project involves the acquisition and rehab of 100 units located at 7200 National Turnpike and 7250 National Turnpike in Louisville. It will serve 100 households at or below 60% AMI, and all of the units will be one bedroom. And I think it's helpful to note that this is a senior project. The development team is available in your packet. KHC staff recommends approval by the Board of Directors of KHC of this final resolution for the issuance of bonds for Yorktown Senior Apartments.
Any members have any questions of Sam on this final resolution? If not, I'll entertain a motion. We approve.
This is George. I'll move to approve.
Thank you, George. Have a second?
Second.
Have a motion and a second. All in favor signify by saying aye.
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 Opposed, like sign. Motion carries. So we're down to Eclipse and Russell. Sam?
Thank you, Mr. Chairman. So this is a final resolution for the Eclipse and Russell. This project was induced by the KHC Board of Directors on August 27, 2020 in an amount of $43 million. The final resolution will be for the same amount. The project consists of 280 new construction units, including 84 one-bedroom units, 112 two-bedrooms, and 84 three-bedroom units. The project is located at 2929 Magazine Street in Louisville and will serve families at or below 60% AMI. The development team is available in your packet, and KHC staff recommends approval by the Board of Directors of this final resolution for issuance of bonds for the Eclipse and Russell.
Okay, any members have any questions of Sam on this project? If not, I'll entertain a motion that we approve.
So moved, Susan.
Okay, thank you, Susan. Have a second?
Second,
Right.
Chad.
Okay, so we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay, so Sam, we're at Shawnee.
Thank you, Mr. Chairman. So this is for a final resolution for the Shawnee Renaissance Apartments project. This project received an inducement resolution at the April 29, 2021 board meeting. This project originally came in as a non-competitive project, but resubmitted once they encountered some additional costs attributable to the historic nature of the project, and KHC awarded them an additional $759,000 and change in affordable housing trust fund dollars in addition to the tax exempt bonds. The project is requesting bonding authority in an amount not to exceed $19,370,000 and involves 177 units, including the acquisition and rehabilitation of 173 existing units and 4 new units across Louisville, Kentucky. It's a scattered site project, so it involves a large number of addresses, but they're all located in Louisville. The project will serve 177 households at or below 60% AMI. The units will consist of 3 efficiency units, 90 one-bedroom units, 46 two-bedroom units, and 38 three-bedroom units. The development team is available in your packet, and KHC staff recommends approval by the Board of Directors of this final resolution for the issuance of bonds for Shawnee Renaissance Apartments.
Any members have any questions? If not, I'll entertain a motion that we approve.
I make a motion, Beverly.
Thank you. Have a second?
This is George. I'll second.
Okay, so I have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay, Sam, you got a personal service contract to talk about?
Yes, thank you, Mr. Chairman. So this is, we are requesting authorization to enter into a personal service contract with Value Tech Realty Services for market analysis services. Value Tech Realty is located in Lutz, Florida, and this would be for fiscal year 23 and in an amount not to exceed $40,000. So in the administration of our tax credit program, home program, rural housing, and other HUD programs, KHC has to adhere to strict performance and reporting requirements, which necessitate a variety of market analysis services. Following a request for proposals in July of this year, Value Tech Realty Services was selected by a review committee to provide market analysis services. Kentucky Housing Corporation has the option of renewing the contract for 2 consecutive years following the initial term of the contract. KHC recommends approval by the Board of Directors of a resolution authorizing KHC to enter into a personal service contract with Value Tech Realty in an amount not to exceed $40,000 for fiscal year 23.
Okay, thank you, Sam. Sam, you've been busy.
Yes, sir.
We appreciate your all's hard work. Any members have any questions of Sam on this personal service contract? If not, I'll entertain a motion that we approve. Was it a motion?
Motion.
All right, thank you. And do I have a second?
Steve will second.
Okay, thank you. So we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Motion carries. Okay, Sam, thank you so much for you and your staff for your hard work on this.
Thank you.
You've had a busy month. Okay, so Wendy, you're going to talk to us about allocation plan for the fiscal year ending June 30th, 2022. And Wendy, before you start, I just want to thank you and Winston and the other staff people for helping out emergency management and the governor's office in regard to the tragedies in West Kentucky and East Kentucky. So I know you all were on site quickly and we appreciate it. So Wendy, go ahead.
Thank you, Chairman, and good afternoon, everybody. So I am presenting a slightly zoomed out version of the more detailed tables and charts that were originally sent to you in your board packet. So what we're looking at is it's some of the same numbers, but definitely zoomed out and hopefully more digestible and in a format that y'all are accustomed to seeing. So you may remember that in May, when we bring you our operating budget, we also bring you what we call our allocation plan. And just to remind everyone, that is our plan for how we're going to invest our programmatic funds into housing activities across Kentucky. Not how we're going to pay ourselves, but how we're going to invest these programs, loans, tax credits, what have you, across the Commonwealth. And so we usually come to you all, I believe it's twice a year, or maybe it's at the end of every fiscal year, to give you a report on the actuals, meaning like what did we had a projection almost a year and a half ago. And in some cases, it's really a guess on our part about a lot of things. But now we have our actual numbers because we've closed out fiscal year 22. And so if you look at this chart that's on the screen, the light blue columns are where we are showing you actual numbers for fiscal year 22 for our different program areas. And I'm going to focus on this table, but there are 2 more following this. The third of which is really, really detailed. It gives you a ton of detail if you're interested in that and has the actuals. What we're looking at right now is the roll up of that detail. Again, trying to offer you all transparency, but not overburden you with too many details. So I do want to highlight a few things on what we're looking at with regard to our FY22 actuals. And the first has to do with our single family lending programs led by Jamie Rice. You can see in that very first row, the actual investment for single family mortgage loans definitely surpassed what we projected. Over $544 million were invested in single family loans across the Commonwealth. That outpaces our expectation, as does the number of households who got a loan. So the folks that we helped buy, in most cases, their first home. That is in large part due to, if you look at the investment per household, which is that last column to your right in blue, it was $163,000 per household. That just reflects that home prices are going up, right? And folks need larger loans. And so that is part of why our numbers have gone up. Our overall investment has gone up and our number of households helped. Going down a couple rows for down payment assistance, you will see that that eclipsed our projection. We projected 16.1 million, and we ended up deploying 17.7 million in down payment assistance last fiscal year. That is reflective of the fact that that's our ace in the hole in terms of loans. People need help with down payment assistance. In addition, we elected to increase the amount of down payment assistance from $6,000 to $7,500 per buyer partway through the year, and so that went up, and the overall amount per unit went up. That's a good thing. It just helps more folks with their purchase power. And then I would like to skip down a couple rows to the Homeowner Assistance Fund. What you'll see is we had no projections because we really didn't know what to project. This is a COVID-19 program whereby we can help homeowners who are behind on their mortgage, taxes, insurance, HOA fee, utilities. It's a pretty flexible program. They do have to have had a COVID financial impact. And so what you can see is as of the end of the fiscal year, we had committed in this new program over $5.5 million committed to help 525 homeowners across the Commonwealth. That program, the total funding is $85 million. So we still have a lot of funds. We have several years to use that. And I know that the overall commitment amount is approaching something more like a $9 million, I think, if I'm remembering Jim Statler right. But so that is a new program. We had no projected numbers because we had no idea what to project. But I just want to highlight that that is up and running and going strong. I will pause there before I move on to another kind of program area set of numbers if anybody wants to ask questions about single family.
Anybody have any questions of Wendy?
All right, I'll keep going.
Okay, go ahead.
And then I do want to note the next one, homeownership production. Our numbers are lower there. We projected a little over 200 units and came in at 171. This is the result in part of a lot of our partners getting back up to production after COVID, as well as material costs being high, the lending environment changing, and the ability to get labor changing for a lot of our partners. This 171 houses represents 34 new homes built and 137 homes repaired where there was an existing low-income homeowner whose home got repaired so that they could stay in it and remains a habitable home for them to live in, often elderly homeowners, but not exclusively. Moving down to multifamily programs, you will see we actually surpassed by just a little bit the number of units that we created or preserved. And the amount invested also eclipsed. It came in pretty close, which I'm impressed with because it's hard for us to get this right when we're projecting it a year and a half out. Going down to rental assistance programs, we do rental assistance for almost 28,000 units every month. We pay rent on almost 28,000 housing units every single month. That was a little bit below projected, and that's mainly for two reasons. A couple of properties fell out of our project-based contract administration. They just sold and decided not to renew with HUD. And then we also are having a hard time utilizing our Section 8 vouchers, especially our new vouchers that are for people experiencing homelessness. Folks are just having a really hard time finding a unit that will accept a voucher. The rental market is so very tight, and landlords can choose not to do the paperwork and the inspection and get very high rent just in the regular marketplace. That is a national issue, and it is a very strong state issue made worse by the disasters in eastern and western Kentucky where housing units were lost, and so the supply has even been more reduced. On the more positive side, if you look down where we say COVID-19 eviction relief, we have helped, as of the end of the fiscal year, almost 43,000 households with rent assistance. That's helping them with some back rent and some forward rent. And so as of the end of the fiscal year, we had deployed $161 million in FY22. That's, that's just something we've never done until the last couple of years, deploying that, any assistance like that, let alone that volume. And that program is still going. And then lastly, I will just note that our homeless and special needs programs, we have some CARES Act funds that we are still utilizing for Emergency Solutions Grant, which offers services, rehousing, and shelter to the homeless. And that has pulled away from our regular homeless programs in terms of our numbers, but when you add them together, our overall numbers, we are helping even more folks exit homelessness and get into stable housing. We're really happy about that. And our weatherization programs came in pretty close to as planned, but the costs have gone up a little bit. Again, material costs are just on the rise, and labor costs are too. So there's tons of detail in here. And again, you go a couple tables in and there's even more detail, program area by program area and funding source by funding source. I welcome any questions, but just wanted to offer you all this regular check-in that we do on how we're doing with deploying our funds.
Any members have any questions of Wendy? And Wendy, this is tremendous work that you folks are doing for the Commonwealth and for its residents.
Thank you.
So go ahead. If you get, do we need Jeremy, do we need a motion to accept that report?
No, sir, it's just information.
Okay. All right, Wendy, go ahead with your personal service contract.
Sure. Believe it or not, I am coming to the board one more time to extend the contract that we have with KPMG for the processing of emergency rental assistance applications under Healthy at Home Eviction Relief Program. So this is, I believe, our third extension of this contract. And really, I mean, you hopefully we'll learn our lesson and we may bring one more of these to you all. We keep thinking we're only going to need them for a very short time, and we've extended it a couple times. We would like to keep them on, particularly because we have added Jefferson County to our service area. We did that in May, and that has just increased our volume in a really significant way, and we really need to keep the capacity that we've got, and we'd like to keep KPMG on rather than having to hire and onboard and train a whole lot more folks. So I come to you asking for this to be, this current one that's already gone to government contract review with the legislature is slated to go through the end of September. Don't be surprised if I don't come back with one more.
Well, you really need these folks to help you. So any members have any questions of Wendy on this personal service contract?
No.
Okay, if not, could I have a motion to approve?
I'll make a motion, Beverly.
Okay, thank you.
I'll
Beverly.
second, Susan.
Okay, we have a motion and a second. All in favor signify by saying aye.
Aye.
Opposed, like sign. Wendy, thank you so much for all you do.
Thanks.
Okay, Jim Stadler, I think you're up.
Thank you, Mr. Chairman. Good afternoon, everybody. Looking at the first chart, which is the pro forma statement of net position. Not wanting to sound like a broken record, but again, our assets have dropped a little bit and our liabilities have dropped by more. And when that happens, then our net worth has gone up by some. And that's exactly what's happened again over the last 12 months. Drilling down just a little bit, line D, which is our total assets, there was a decrease of 15.9%. Much of that is in cash and investments, and mirrored by a big drop in one of the big liabilities, line H, which was the pension liability we had on the books at the beginning of the year and no longer have on the books. And so we did pay that off during the year, as you're aware, and it did suck out $90,000 of our cash and investments, and that's reflected pretty much on this schedule. If you go to line K, which is our net position prior to a mark-to-market adjustment, you'll see that our net worth would have gone up $38 million or $39 million from last year to this year. We are required to book our securities down to market, and when rates go up, security values go down, and that impacted our financial statements by a little over $13 million. So our actual increase in net position was about $26 million. It's reflected on line M, from 404 $431 million. And the reason I prefer to break this number out is there's nothing we can do about the mark to market. All the other numbers we can do something with. We can manage through, we can take actions on, but we can't do anything with the mark to market. And so it helps me understand how did we do with the stuff we could do something about, and then how much did we have to live with because of something we couldn't control. And so, when in years such as this, when market values go down, it looks like we're making excuses. But when market values go up, we don't take credit for it then either. So it does keep everything in a little bit in perspective on how are we doing with things that we can do something about. Again, concentrating on lines N and O, the annuity stream or annuity that we have generating year to year to year to year income is our servicing portfolio. And we have traded over the last several years on balance sheet loans that were arbitraged against bond interest expense with off balance sheet servicing. And it has actually grown in the last 12 months, which that basically turned around in the fourth quarter, where payoffs have finally stopped, or not stopped, but they're down about 30%. And our loan production that you saw on Wendy's chart was held pretty steady. So we actually grew from $2.3 billion to 2.4, a 2.8% increase. And we'd love to see increases in that figure. The last line, line O, how much are we making on that servicing for others? That actually shows a decrease of 1.6 basis points. 1 basis point decrease in that number costs us about $250,000 a year in servicing income. And so you can see that the running rate per dollar of servicing dropped a little bit from last year to this year. I will say that the 31.5 average servicing fee at June 30 is actually higher than the average service fee at the end of March was, just incrementally. But not only is the servicing portfolio growing, it's growing at a earnings rate that's a little bit higher than it was earlier this year, but not as good, quite as good as how we ended the last year. If we go to the next schedule, this is a
Jim, just let me.
Oh, I'm sorry. Yes, sir.
Before you go to that, just let me make a comment about that $13 million decrease. You actually do not realize that decrease unless you sell those bonds. I think it's important to note that for the board.
Absolutely, that's right.
That's just an accounting function, right?
That's right. Yes, yeah, and it's one you just have to live with when you have, particularly in the bond portfolio, we have to invest the funds. We can't spend them. We have to invest them, and so when the investments lose value, that gets reflected from an accounting standpoint. But it's not a cash loss until you actually sell them, which we have no intention of doing.
Right. Okay, I'm sorry. Go ahead.
No, that's an excellent point, Mr. Chairman. This is the red and blacks chart that I present periodically, and as we got into the last third of the chart, you could see that the growth convexed, and we actually went down in servicing portfolio size, and you can see the rightmost bar, the red bar, that has ticked back up a good bit higher than December of 21, slightly higher than June of 21. But now headed in the right direction again, where we're growing portfolio instead of losing it. The illustration here is that back in the day, if you look at the left side of the chart, we had bonds and loans on the books, which would have been the trend line is the black part of that. And you can see that as the bonds decreased, we were still able to maintain a large investment in an annuity stream that will pay us over the next several years in the form of the off-balance sheet servicing portfolio. And so the execution on the secondary market was superior to execution in the bond market. And we didn't give up any future earnings per se because we were able to maintain an off-balance sheet servicing portfolio. Going to the income statement. And again, this is the business type activities, which is the what we call proprietary side or the non-government program administration side. If you look at line C, which is net interest margin, there was an actual increase in the net interest margin, even though the overall earning assets and costing liabilities went down. We did refund a bunch of bonds in last week of September, and the other piece was the second week of October, where we dramatically were able to decrease the cost of those bonds. And so we were actually able to decrease our interest expense by $2.8 million. And then the investment income on our bond and our loans, mortgages, and marketable securities actually ticked up just a little bit for a net increase in net interest margin of $3.1 million. Line D, not a good number. We had marketing gains on the sale of our loans of $35 million last year, and only $16 million this year, a decrease of $19 to $20 million. As I have said to the board many times over the last 3 or 4 years, the prices we were getting in the past were, in my opinion, outrageous, and they've returned to some normalcy, and if not, just a little worse than normal in today's market with interest rates going up and the volatility, particularly in the MBS market, which is the market that we deal in. And so a big drop from last year. It's still a decent number that we produced at $15.8 million. The running rate this year is even a little bit less than that. But we are generating servicing portfolio with that, and it's still not costing us anything to put that portfolio on the books. Line E, fees. We were able to increase our fees from $17.5 to $19.5. A lot of that's on the multifamily side. New projects come on, we get a fee for bringing those on. And also during fiscal 22, the pent up or all the forbearance payments that were embedded in our servicing portfolio have started to cure, if you will, either with the end game from the insuring agencies or with the homeowners assistance fund, which we're administering. And we're collecting significant amounts of back payments. Embedded in all those back payments is a lot of interest income, a lot of cash, and a little bit of servicing fee income, and that's reflected on this line. Last year's it was suppressed because of the forbearance. This year, we're earning it out and getting the cash back. Line F, this is where on the income statement, the decrease in the value of our securities is recorded. And again, it's not the exact same number as on the balance sheet. This is the impact during the year, not the impact at the end of the year. So it's a little bit different benchmark, but in general terms, it's about the same. And it shows that the revenue, it gets booked through revenues. We lost, if you will, $12.8 million on our securities during the year. Again, it's an unrecognized or an unrealized loss, so it's recognized for accounting purposes, but not reflected as actual cash. Getting into a section of the statement that's even harder to explain. Last year we had $8.5 million. I'm on line H, general administrative. We actually had an $8.5 million credit on that line. It's a negative expense, if you will. And this year we have a $15 million expense. That's totally due to the how we had to run through the pension cessation transactions. We had a big write-up or a boost to income when we decreased the liability to get out of the pension that we had to record at June of last year. And then we don't have that boost this year. And you can see that it's a $24 million swing. But overall, and we're still analyzing the G&A just a little bit to see where the exact components are. Our G&A did go up. There were inflationary pressures embedded in there, but there was also a lot of G&A that was recovered through admin fees, and that's been credited out of this number here. So we're still doing a little bit of analysis on that. But generally, we are not immune to inflation. So we do have inflationary pressures primarily on our largest cost piece, which is compensation. But we were able to enjoy in fiscal 22 significant reduction in our pension costs. And we've estimated that the reduction in our ongoing pension costs on an annual basis is between $5.5 and $6 million. And so clearly that will benefit us for years to come from a net revenue standpoint. We bit the bullet last year and paid a big slug, and that's now behind us. One line that you might sit here and it's not labeled actually, it's the blank lines, interest on pension liability. We actually had to pay interest on what we owed, even though we didn't know how much we were going to have to pay for 8 months last year. And so when the interest bill came in, we knew it was going to be in the $1.5 to $2 million range. We did pay that. That's a non-recurring expense of interest on that bill. And so we won't see that again in years to come. The other numbers are relatively nominal. But if you go to line M, you can see that it looks like our operating income dropped from $73 million last year to $21 this year. There's $35 or $40 million of wrong side impact from the pension. from last year. And so it's not as grave as it might look like, that there's a $52 million reduction in operating income. Some of that pension is actually offset in the next line. It's an accounting anomaly that goes between the proprietary side and the governmental side, and it shows a $17 million drop in net income, or positive change in position, which is a little bit more reflective of what actually happened. Then you can see the net position between the beginning and the end of period is the same numbers we looked at on the balance sheet before. And then again, taking the mark-to-market impact out of the statements, if we had not had to book the $12 million write-down, our income for the year would have been about $38 million versus the 45 that we reported last year. So not a great year. The secondary marketing gains was disappointing, particularly in the fourth quarter. But there's good long-term offsets. The portfolio grew. The pension expense going forward is significantly reduced, and we're able to get some of our indirect costs charged over to some of the governmental programs and collected back in the form of admin fees. So we're doing a lot of things right. The market was against us a little bit this year from the secondary trading side and the mark-to-market side of our securities. Any questions on the income statement? I'm just going to touch on a couple of lines here. Line B on the cash flow statement, you can see that our negative cash flows last year were $44 million. This year, it's $161 million. Most of that is the pension. We paid a bunch of pension. That's where we paid it out of cash flows from non-capital financing activities. And then if you look down at the bottom on lines K and L, you can see that this year we paid back a lot of debt and incurred a lot of debt. That's the impact of the bond refunding we did in the end of the first quarter and beginning of the second quarter last year. So everything makes sense, the ins and outs, and so no surprises there, but it does show that cash is moving. Big amounts of cash are moving. Bigger amounts are moving on the governmental side, which are not reflected here, as we've helped countless thousands of our fellow citizens here in the Commonwealth. If no questions there, let's go look at some of the budget versus actual. This is the income side. You can look at, I'm looking at the second column from the right, which is the favorable dollar variance, or unfavorable if there is one. Line A, which is rental assistance, we had almost $1 million favorable variance. Our revenue went up. Our fees per case went up. We did have increased number of vouchers as well, which were not not actually forecast in the budget. The big budget bust on the positive side is line C. We had projected $8.7 million coming in from the HHERF and all the other COVID initiatives. We actually brought in 14.8. That's a $6 million positive revenue variance. When we get to the next page, we'll see that it's offset by a $6 million increase and negative variance on the costs that we incurred to get reimbursed on the positive side here. So it's a wash, but it shows up gross on the revenue side. It shows up gross on the expense side. And then line E, which is the where the homeowner assistance fund is, we had a lot of upfront costs, programming and software development that happened during fiscal 22, and some benefits actually paid out when the program got launched. And again, the cost of putting those systems in place are reflected as negative expense variances on the next page. So again, everything makes sense. We incurred expenses to get the revenue back, and that's exactly what the statements are showing. Looking at the other fees and admin reimbursements, we underguessed or outperformed servicing fee by only $400,000. Most of the year we were getting slammed with payoffs, and so we turned the portfolio and came in a little bit over budget. Rental production, which is generally the multifamily side, we did close a few more properties than we did in last year, and had an $876,000 favorable variance. And you can see that a couple of negative variances. The home ownership piece, those are negative. We changed the product mix a little bit, and we did not reflect that in the budget last year, and so it filtered through as an unfavorable revenue number. And then we did not receive nearly as many price maintenance fees from lenders who couldn't meet their delivery obligations. They were a little bit better on delivering products, so we underbooked or didn't realize as much on those fees. Looking at line N, we were positive on fees by $9.1 $9.16 million. And then that's the income side, and we were negative to budget, $6.4 million on the operating expenses. Basically incurred more expenses than we thought, but recovered far more than that, so that we were positive on a net basis on the budget by about $2.7 million. Always good to outperform the budget on a net basis, and I think that there's a number of reasons why we were over on fees and over on expenses, and then I think the big driver this year was we were under on a lot of budgeted expenses. When we did the budget for fiscal 22, we anticipated COVID exiting the scene a little bit more rapidly than it did, and a little bit more return to normalcy, and budgeted trainings and travel, and ended up not doing it, employee development, and not actually investing in those activities because COVID just well, as you all know, it's just hung around for a while. It's still out there. Looking at some specific lines, in general, again, I'm looking at the favorable, unfavorable, second to the last column. If there's a big unfavorable variance, it's almost entirely attributable to COVID and COVID expenses we incurred in administering the COVID relief initiatives. We incurred more payroll than we had budgeted. We incurred more contractors and temps than we budgeted. We incurred more temporary or the big contract of the $5.5 million negative on line E. That is some programming that we paid to another state agency to assist us in a couple of our portals. And then also the KPMG contract is in there. Computer operations, we have more people consuming more data. So that was a little bit over budget on a negative side. Office supplies, printing and public information, all those are accounts that we incurred more than we budgeted to handle the increased and high level of aid and initiatives that we were administering. And then the large positive variances you can see in occupancy expense, foreclosure costs and release fees, employee development, travel, and legal fees. That's a reflection of not incurring those expenses that we didn't travel, we didn't do a lot of. We did a lot of employee development. We did not do the robust employee development that we had budgeted for, and so we experienced positive variances there. And so overall, like we saw on the page before, 6.4 negative on expenditure budget versus actual, more than offset by positive revenues on budget versus actual, and a net of $2.4 million surplus to budget. And so again, not a fantastic year. But clearly better than most of the years of the last 15 or 20. And we delivered a hell of a lot of benefits to a hell of a lot of people here in the Commonwealth at a time when a bunch of those people needed it. And so, and all I do is keep track of it. And the Wendy's of the world and the Johns and those folks, they deliver the aid, and all I have to do is count the money and make sure there's money there when they want to distribute it. So the whole thing worked on all 8 cylinders this year. We're still firing away. We've got a lot of work to do still with climate disasters in the western part, the eastern part of the state. But overall, I think we can put this one in the books and feel good about what we did and march forward into fiscal 23.
Jim, you do an excellent job of keeping track of it, and we appreciate it.
Thank you.
And I do have one question. Printing and public information up quite a bit. Is that so you could get the word out about the national programs?
Yes.
Okay.
Yes, that's getting there is some marketing. I think actually that also has some of our marketing that we did around Derby. But most of that is getting the word out in print and mostly radio, letting people know that there's help out there and where to go get it.
Very good. Okay, any members have any questions of Jim? Jim, that's an excellent job, and we appreciate all your hard work and your staff's hard work on this.
Yeah, I got a lot of help. I got a lot of help out there. Thank you, sir.
Thank you. Okay, if there are no other questions, Jeremy, do we need a motion to accept this financial statement?
No, sir. It's informational only.
Okay. All right, so we'll move on to the report of action of the executive committee meeting held on August 11th, 2022. And Jeremy, I misplaced my sheet on that. Can I yield to you to let you describe what happened?
Yes, sir. And Wendy may need to chime in for me a little bit, but I think I've got it. So KHC was in a position where we had some dollars that we administer that are the Family Self-Sufficiency Program dollars that are part of the Section 8 program. And HUD had made some changes that necessitated us making an amendment to our plan for utilization of those dollars before we could access those dollars again. And the process for that was that the board had to approve some amendments to our plan to incorporate the changes that HUD had made. Once we did that, we submit it to HUD, which has 45 days to give an approval, and we have to wait for them to approve it before we can utilize those dollars for the Commonwealth again. So every day that we delayed of not getting action from the board was an additional day that we were going to be delayed in being able to deliver those dollars to the citizens of the Commonwealth. For that reason, we did convene, despite having this meeting scheduled for the full board, we convened the executive committee a couple of weeks ago in order to go ahead and get that action done by the board so that we could get that submitted to HUD in order to be able to access those dollars quicker and get them out to the citizens of the Commonwealth. The family self-sufficiency dollars, and this is where Wendy may need to chime in a bit, but they are dollars that are used to provide some education and also to allow for people who are receiving Section 8 rental assistance to be able to do some savings of money in order to potentially have a down payment for a home one day or some other things, but it includes some financial education for recipients of Section 8 housing in order to, do more than just put a roof over their head and, give them a little more opportunity at bettering their situation if they wish to do so. Wendy, if I misstated anything or I missed something, please feel free to chime in. But that was the gist of the meeting.
You captured it well, Jeremy.
And so in the course of that meeting, those plan amendments were presented to the executive committee and they voted to approve those. So that was approved at that point, and I believe it has already been submitted to HUD so that we can get those dollars out.
Jeremy, does the board need to follow up with an approval on that?
No, sir. The executive committee has full authority it has the same full authority as the full board.
Okay. All right, good. So do any members have any questions of Jeremy or Wendy as to why we had to have that meeting? It was important to get that done on a timely basis and get that moving. So Jeremy and Wendy, we appreciate your help on that. All right, so informational items. Winston Miller, appreciate your hard work and your effort, and I appreciate you always keeping in touch with me. And so I'm going to turn it over to you.
You're on mute, Winston.
Winston there?
I hope I am now.
Okay.
You are.
Here we go.
You hear me now?
Yes.
Yeah. Thank you, Mike, very much. Jump right into a couple of, and let Wendy Smith give us a couple of updates on the Western Kentucky situation and the Eastern Kentucky situation.
Yeah, I'll just say that with regards to Western Kentucky, there are a number of long-term recovery groups that have formed. Some cities or towns are further along. Mayfield in particular has engaged a planner and are doing a lot of planning. Bowling Green has a strong planning department and they are doing a lot of planning, reaching out to developers and that sort of thing. And I know that Sam Thorner has been thinking about a funding round for multifamily development in along with bonds in Western Kentucky. Now, what happened with the flooding about a month ago in Eastern Kentucky may change the shape of that, right? It might include both of them. Remains to be seen. I thought I would give you all a rundown of what we've done in regards to the flooding in Eastern Kentucky. And I want to say before I dig into what KHC has done that it's clear to me that we as a staff, but more importantly, that the state and the governor and all of the state agencies that have been really responding in a far more urgent way than is our role, that they have learned so much from Western Kentucky and are applying that in real time to Eastern Kentucky to try to speed up that process, get better outcomes, alleviate some of the burden on local and county governments. It's been very impressive to me as someone who's not part of emergency response, but it's really been great. So with that, I'll share with you what KHC has been doing. So first, we reached out to all of our staff in the area, our Section 8 tenants, our properties that we have subsidized, and partners in Eastern Kentucky, just to understand who's been affected and how, and do they need, a handful of our Section 8 tenants needed to get a voucher to move somewhere else because they lost their unit. Not many, though, I'm glad to report. We also we moved up our internal debrief of lessons learned for Western Kentucky. We were planning to do that like in a week or so from now, and we moved that up quite a bit so that we could talk about what we felt went well, what we didn't, what we would do differently. We have met with a bunch of partners already on the phone, sometimes in person, virtually. So we've met with FAHI, which is a really important intermediary that works with housing nonprofits all across Eastern Kentucky and in many states, I want to add. We've met with USDA, Habitat for Humanity of Kentucky, a number of single-family nonprofit developers who build homes and repair homes in Eastern Kentucky, as well as some Eastern Kentucky homelessness organizations. Probably the biggest difference for my staff and I for Eastern Kentucky versus Western in these disasters is that we have a really strong backbone of partners that do different types of work that we fund in Eastern Kentucky. And so that's a game changer in terms of thinking about short-term issues and long-term recovery. So with that, we have gotten some additional operating funds to a handful of our partners who will not be able to do the regular work that they do with us. And that's how they make their money. They build a house, they get an admin or a developer fee, and everything's flooded. They're not going to be able to do that, but we need them to stay afloat for long-term recovery. They are helping with muck out and cleanup and planning. So we need to sustain them. So we have already gotten operating grants out to 4 agencies, and we've held back a little more in case we need to help some other agencies. In addition, we have met with our homeless partners and are about to connect them to the Red Cross and Kentucky Emergency Management folks who are overseeing emergency sheltering in congregate shelters, at the state parks, and in trailers. We would like our homeless agencies to be able to go do intake alongside Red Cross and KYEM so that if someone does qualify for homelessness services and funding, we can fast track them to connect them to that. We didn't do a great job of that in Western Kentucky because we didn't know what we didn't know. We'd like to do that better. And those partners are very interested in making that connection. Winston and I regularly participate with interagency meetings. They were every day at 4. They're now 3 times a week in the late afternoon. And yesterday there was a gigantic meeting with heads, leadership, of federal agencies, KYEM, state agencies, and local officials from Eastern Kentucky, mayors and judge executives. It was a very useful meeting, to my surprise. Sometimes those can be, less useful than you think. We are currently building an inventory of available rental units in and really more likely around the affected areas. We did this for Western Kentucky. We have about 150 units in our inventory right now. And so we've already shared that with KYEM folks, and we'll be sharing that with partners all across Eastern Kentucky. And we just send out tons of e-grams and information to our partners, letting them know about FEMA appeals, anything the governor has announced, all that kind of stuff. So that's a snapshot of what we've been working on.
Thanks, Wendy. Appreciate it. Does anyone have any questions that for Wendy or for I about where we are with West Kentucky or East Kentucky? there's a lot going on. West Kentucky is moving into that real planning phase, which is much slower, and which there are many more parties out there making a lot more decisions about, or a lot of decisions about what's going to happen in the future, rather than us, including the Department of Local Government and local county governments, et cetera. And in Eastern Kentucky, things are still very, very early, and people are really trying to decide what the best options are for proceeding. A lot of people involved, a lot of people concerned, and that's going to continue for a while. In terms of laying out any definitive plans in terms of long-term housing, those are yet to come, either in either location. But we're involved, and we're seeking to do what's in the best interest of the Commonwealth, as I think everybody else is that's involved in the process as well. But there's not any really greater detail that I can provide, or that we can provide at this particular point in time. Having said that, as an additional sort of informational item, it's the end of the fiscal year, and I want to thank everybody at Kentucky Housing Corporation for everything they've done last year to make this year another great year for the Housing Corporation. It has been a year. We've done so many things that we've never done before, or at least we've never done at the volume that we've done, and continue to do those things. And well, this has put a lot of stress and strain on a lot of folks at Kentucky Housing, but everyone has continued to perform and do an excellent job. And if I start singling people out, I'm going to miss a ton of people, because almost everyone is worthy of singling out. But the two people I will say something about, I think they're worthy of comment on circumstances of the past year. And first, really and foremost, is Jim Statler. Jim continues to guide us financially in a way that no one else can, and gives us the financial insight that we need to do what we do. And we continue to appreciate deeply the work that he does. The other person that I think is deserving of exceptional mention is Wendy Smith. Wendy has stepped in and assumed responsibilities that did not fall squarely in her area of responsibility, and has performed admirably in working with disasters, emergency rental relief plans, and the increased funding with all the other federal programs that we've received that are focused on the homeless and the other federal programs that we administer. So I'd just like to express my words of gratitude in the presence of the board to, again, all of the staff, and to Jim and Wendy. Mr. Chairman, with those items, that's all I have for today. Mike, are you there?
I suspect that the chairman has stepped away. Secretary Johnson, could you, as vice chair, assume the chair of the meeting and get us adjourned?
Well, then I would like to echo what Winston just said. I think the staff has stepped up and just really shown their dedication and their hard work, their work ethic, and just done an excellent job, and have just truly gone above and beyond. And I just do want to echo that, because I'm in a lot of those meetings as well, and they're always bringing good ideas to the table, and it's reflective of the work that they're doing constantly in those meetings. So I just want to echo what he just said. And with that, I will take a motion for adjournment.
A second.
Okay. Then I guess if we have no opposition, we will be adjourned.
Can we treat that as a motion, please, and get a second?
And I'll second.
Thank you.
Okay. Thank you very much.
Thank you.
Mhm.